Hi everybody, my name's Griffin Bridgers. Today we're going to talk about rights to withdraw income from a trust and look at the principles of Revenue Ruling 66-87 and how those shoehorn into some other types of code sections and treasury regulations that might affect this type of right if it's contained within a trust. Now before we start, I want to remind you this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. So, when it comes to income distributions, you often have two choices. You can make them discretionary, where a trustee has the power to determine when and if the income is doled out, or you can make them mandatory and create a structure where all of the income has to be distributed to a beneficiary every year. Now, definition of income aside, which is going to be its own issue we'll talk about in a few minutes, there's often an assumption that if there's a mandatory income right, the trustee has to be the one to control that right and make those income distributions and force the income out. But you may not have to get there, especially if you're using a mandatory income right to satisfy some other tax code obligation or requirement for mandatory income. So instead, our big question of the day is, could you perhaps satisfy that mandatory income right by instead giving a beneficiary the right to withdraw all of the income on an annual basis, which they can choose to exercise or choose to not exercise and just leave the income in the trust. So for example, let's take a Q-tip trust. There's an annual income distribution requirement, but the spouse only needs to be entitled to all of the accounting income of that trust. There's no requirement that the trustee force all of the income out of the trust every year. So instead, what if we were to say perhaps the beneficiary spouse could just simply withdraw all of the accounting income on an annual basis? That may be enough to satisfy the Q-tip trust requirements. Similarly, when it comes to the gift tax annual exclusion under Code Section 2503B, you can meet the present interest requirement sometimes by setting up a trust that provides life income at least annually for a beneficiary. So again, instead of forcing the income out, perhaps taking a page from the crummy withdrawal structure, we could accomplish this goal by simply allowing a beneficiary to withdraw all of the income of their trust every year to be able to use that gift tax annual exclusion by meeting that present interest requirement. So, against that backdrop, it's easy to look at all of those potential pluses, but there's a sentiment in the estate planning and tax planning community that withdrawal rights should be avoided at all costs outside of narrow bands such as crummy rights where it's become ubiquitous. Now, the issue with rights of withdrawal and why this causes so many headaches is the estate and gift tax treatment of withdrawal rights. Because generally, any right to withdraw assets from a trust and give them to yourself will be a general power of appointment. In this case, that withdrawal right over the income is a general power of appointment over the income. And these do not go away easily from a gift or estate tax perspective. Code Section 2514B provides that if you either exercise that right in favor of another person instead of yourself, or if you release it, that will be a gift, no matter what the value is and how much is released. We can move a little further and just say, hey, if you put up your hands and don't do anything and just let the withdrawal right lapse, then Code Sections 2514E and 2041B2 both provide the same thing, that lapse of the general power of appointment will be treated as a release and thus a gift to the extent that it exceeds the greater of $5,000 or 5% out of the assets of which or proceeds of which that power could have been exercised, which is really going to form the core of our argument. Most of the time, the income might be greater than $5,000. So is there a way you can finagle in this 5% to get over that threshold and perhaps use up all of this lapse exception? Now, before we move on, I want to note that this 5x5 limitation only applies to a lapse of a withdrawal right or a lapse of a general power of appointment. It doesn't apply to a release. So you can't release the withdrawal right and try to sneak in under this $5,000 5% limitation. This is only in the case of a lapse, which kind of brings us to the issue of income of a trust and your ability to withdraw it on an annual basis, because that income, whether it's accounting income or taxable income, is going to be accrued and reported on a calendar year basis for most trusts, because most trusts have a calendar year tax year and typically will have a calendar year accounting year as well. So generally what this means is at the end of the calendar year, any income that's not withdrawn will get added to principal. So what's the significance here? Well, what it means is that this could be a lapse of a general power of appointment over that income that could have been withdrawn, unless you create what's called a cumulative right or hanging power, where that power to withdraw the income continues to apply to the portion of income that's indeed added to principal after the close of the year. So what's the outcome here? Well, we have a possible gift now to the other trust beneficiaries. But you only have a gift to the extent the income exceeds that $5,000 or if greater 5% limitation, unless you can show one of two things. One, you can show that the gift did not go to other beneficiaries. So if the income beneficiary was the only beneficiary of the trust for life and the estate was entitled to take out the unwithdrawn income, then you wouldn't have that issue, but essentially you're kicking the can then so that all unwithdrawn income ends up as part of the gross estate from an estate tax perspective anyway. You could also make the gift incomplete, usually by the beneficiary's retention of usually a limited power of appointment over the unwithdrawn income, but it could be a general power of appointment as well. But again, this kicks the can to essentially make this an issue where all of the unwithdrawn income that's added to principal gets included in the beneficiary's gross estate at death. And this was generally what was at stake in Revenue Ruling 66-87. Now, we only saw this principle illustrated from the perspective of a decedent's final year of life, but nonetheless, this is a rabbit hole that luckily the service didn't dive down, but could be more extensive than we think. Now, the facts here were simply a deceased spouse who had the non-cumulative right to withdraw all of the income from a trust annually. That trust had been established by her husband. So what was at issue was the estate tax treatment of that unexercised right to withdraw income that existed at her death. Now, as we know, Code Section 2041b2 has that lapse limitation to say that there's no estate inclusion here to the extent that the lapse does not exceed $5,000 or if greater 5% of the assets out of which that withdrawal could have been made. But what are the assets out of which the withdrawal could have been made here? In this case, the question whether it was just the income or whether it could include the principal as well, because if it includes the principal, then you're looking at a much larger pool, and 5% of the principal could easily exceed that $5,000 limitation and thus use up all of the income. But if it's limited income, it may be the case that the income of the trust for the year, or up to the spouse's date of death, exceeds $5,000, but that excess income could end up included in the spouse's gross estate if we don't get the benefit of a greater 5% lapse threshold. Now, unfortunately here, the service said that the power only extended to the income, so the only quote-unquote assets out of which the decedent could have exercised her withdrawal right were indeed the income of that trust. So in this case, any income in excess of $5,000 in the last year of the decedent's life was included in her gross estate. The first $5,000 of income wasn't, but the excess over that was due to that lapse threshold under Code Section 2041b2. Now, what was not addressed here and what creates a rabbit hole is the past gift tax issues for prior year's lapses in this case and what might have happened to that income, especially because this was a non-cumulative income withdrawal right. But that's a subject for another time. Now, I'm going to quickly touch on another twist that often comes up in this situation where you see withdrawal rights, and that is that the right to withdraw income doesn't just make a general power of appointment, but it can also make this a grantor trust with respect to the beneficiary under Code Section 678A. But that only applies if the actual grantor of the trust themselves is not already the deemed owner or grantor of the trust under the remaining grantor trust rules. That exception is carved out under Code Section 678B. Now, really where we see this arise, where a beneficiary can become a deemed owner of a trust, is Code Section 678A1, which kicks in wherever a beneficiary has the right or power that's exercisable solely by that beneficiary to vest the corpus or the income of the trust in themselves. Now, what's important here is that that definition of income relates only to the taxable income and not to the accounting income under the grantor trust rules. What's the significance? Well, accounting income usually only includes immediate items of income that are earned and distributed in the current year. So interest, dividends, rents, royalties, things like that. We could also have things like extraordinary dividends and capital gains, which may not be distributed immediately in the year. Those might get added to principal under trust accounting rules. Now, when you have a grantor trust, the question becomes, does that include the taxable income or the accounting income? And a lot is going to relate there not to the grantor trust rules under 678, but instead to the terms of the withdrawal right itself. So in this case, if a beneficiary has the right to withdraw accounting income, they're going to be taxed on the accounting income only, regardless of whether or not it's actually withdrawn, which can create some benefits, but that won't extend to taxable income, mainly because the definition of income in the grantor trust rules refers to portions of a trust that can be taken out and by default to taxable income and not accounting income unless the grantor trust rules say otherwise. So there's a whole other rabbit hole we can dive down here, but I encourage you, if you're interested in this, to check out Ed Morrow's work on the Beneficiary Deemed Owner Trust, or BDOT. He has extensive resources about the nuances, especially around this code section. So what are our key takeaways here? So if we can manage this lapse issue somehow, income withdrawal rights could provide potentially some greater flexibility when we structure a trust so that we don't have to force all of the income out to a beneficiary who may not need it ultimately, or may not be treated well from a tax perspective if they receive all of that income. So there's a few ways we can deal with the lapse issues, and this is by no means all-inclusive, but we can take a page from how crummy rights are treated. So we could consider, hey, maybe we treat this as a cumulative right, like a hanging power, where the income that is not withdrawn but is added to principal continues to be subject to that power of withdrawal until it lapses out, because some years the income may be greater than 5% of the value of the trust. Some years it may be less. But if we could dip into that principal a bit, at least to the extent it's comprised of the unwithdrawn income, that may allow us to leverage a little bit more lapse threshold, especially as this right continues to accumulate and crosses the $100,000 cumulative threshold where 5% becomes greater than $5,000. We could also look at the beneficiary, if they don't need the income, perhaps just taking it out anyway, and then using annual exclusion gifts to gift away that income that's not needed in any given year. So, in that context, the biggest flexibility benefit here is whether we could achieve income tax savings using the grantor trust rules, and perhaps if we do, and we have this risk of increased estate tax from accumulated unlapsed withdrawal rights from prior years, could it be that the income tax savings throughout the years might exceed any increase in the estate tax through gross estate inclusion? So a lot of that will depend on the amount of the income in any given year. Now, obviously, if you have very high income, over $100,000, then you could easily get into a more beneficial lapse threshold where there's 5% of that income and not 5% lapsing out every year. But we could also consider extending it a little bit further and also considering the GST tax ramifications here, but both are a topic for another time. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com with the caveat that I cannot give tax or legal advice in response to your questions. But I thank you again for listening to this video, and I look forward to seeing you in my future content.